Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's get straight to the top story this evening. The Reserve Bank has announced the monetary policy decision, which is largely in line with the results of the CNBC TV18 monetary policy poll. So let me quickly take you through the top highlights that you need to remember. The central bank hiked the repo rate by 25 basis points to 6.50%. 60% respondents of our poll were expecting this hike. Now, with this, the reverse repo rate, the rate at which RBI borrows money from banks, stands at 6.25%, and the marginal standing facility rate stands at 6.75%. Now, this basically is the rate at which banks can borrow funds overnight from RBI against government securities. Shifting focus to the tone of the central bank statement, the monetary policy panel has kept its policy stance neutral with the objective of achieving 4% consumer price inflation in the medium term. The other highlight from today's commentary is RBI Governor Urjit Patel warning regarding possibility of currency wars. He said that we are possibly at the beginning of currency wars, but reassured that India has things in its favor.
There is considerable uncertainty around the full impact of the MSP changes on inflation, which will only resolve in the next several months once the price support schemes are implemented and rolled out across the commodities. The committee decided to increase the policy rate by 25 basis points while maintaining the neutral stance of monetary policy. The committee reiterated its commitment to achieving the medium-term target for headline inflation of 4% on a durable basis while supporting growth. The trade skirmishes evolved into tariff wars, and now we are possibly at the beginning of currency wars. Given this, we have to ensure that we run a tight ship on the risks that we control to maximize the chances of ensuring macroeconomic stability and continuing with a growth profile. We do have things that are in our favor, which you are aware of, and if we continue along that path, we ensure that we don't add to the global risk profile that would adversely affect us.
All right, so that was Urjit Patel in the press conference that ensued just a short while ago. We got several reactions, and we will have Lata Venkatesh to get us a quick analysis of what this means. But first, let's quickly take a look at how the market reacted. The Lal Street saw wild swings post-policy announcement, with indices snapping 4-day gaining streak. So the Nifty ended flat, just shy of the 11,350 mark. Sensex managed to hold on to the 37,500 mark, ending with cuts of about 84 points. Banks saw volatile movement post-RBI's rate cut, managing to end with cuts of over 150 points. Meanwhile, mid-caps outperformed today. That index ended with about minor gains of roughly 0.2%. Surbhi Upadhyay joins in now with highlights of today's trading action. Surbhi, it was very clearly a volatile day of trade, but what were the major reasons for this?
Well, the event is out of the way. A 25 basis points rate hike delivered by the Reserve Bank of India, and this event today at least worked in favor of the bears. Extreme volatility towards the last 1 hour of trade, particularly the last 30 minutes when the market was really digesting the policy. A lot of movement on bank stocks, and I'll come to that in just a bit. But along with the RBI policy, another thing that the market had on its mind today was a worry of a subpar monsoon. Some of the private forecasters already gave out their projections for the full season. And SkyMed, for instance, is expecting monsoons to be below average. When we come back to trade tomorrow, we'll have the official data from the IMD. So that is something that the market will keep on its mind as well. Now let's quickly drill it down to stocks. As I said, financials were leading the route today. So whether it's some of the corporate lender names like ICICI Bank or Axis or even the HDFC twins, a lot of these stocks were down. SBI bucked the trend to an extent, but even that stock came off the earlier highs. Let's move to Motown, and autos were really in slow lane today. Maruti led that route because of sales numbers that weren't very inspiring for the month of July. The two-wheeler makers like Eicher Motors, Bajaj Auto, Hero Moto, all of these stocks were also down and out. Metals were definitely not shining. So whether it was Hindalco, Tata Steel, or even a Vedanta, stocks were down between 2 and 3%. What was working then in favor of the upside? Well, some of the old favorites, Reliance, TCS, and even in ITC, these were stocks that were still powering through. HCL Tech had a good day as well. And also bucking the trend of the weak down move was something like Coal India and some of the pharma names like Dr. Reddy's and also Lupin. I'll come to result reactions, and today wasn't a very inspiring day with respect to earnings. It really started off with Imami's subpar performance. That stock ended down about 4 to 5%. We had weakness on Tata Global after the numbers, and ditto for Raymond. Last but not least, let me quickly talk about some of the green stocks on the screen. So we had an interesting buying pattern on Ashok Leyland immediately after the sales data was out. The numbers were looking good and sort of market lapping up that stock 5% higher. Hindustan Copper, with a lot of talk about the company fundraising via a QIP, so that stock was also up 6-7%. And last but not the least, Gati was in focus today, also about 6% higher. The big event is over. We need to come back and see whether today's trade was just a one-day phenomenon and whether the uptrend can resume from tomorrow, or whether the RBI policy is actually capping gains, at least for the immediate term, for this market.
Here's another big story from the national capital. There seems to be good news for LIC and IDBI Bank. Sources tell CNBC TV18 that the cabinet has cleared the purchase of 51% controlling stake in IDBI Bank by LIC. Now, the state-run insurer already has 7 to 7.5% stake in the bank and will acquire the remaining for a majority holding. Sapna Das is here with the details. Sapna, so the controlling stake in IDBI Bank now definitely goes to LIC. It's just a matter of a procedure now to see the deal go through. Take us through the timeline. Already has 7 to 7.5% stake in the bank and will acquire the remaining for a majority holding. Sapna Das is here with the details. Sapna, so the controlling stake in IDBI Bank now definitely goes to LIC. It's just a matter of a procedure now to see the deal go through. Take us through the timeline that we can expect now.
Well, absolutely right. And let me just kind of point out here that this is exactly what CNBC TV18 has been reporting consistently, that the government will be shedding its management control in IDBI Bank in favor of LIC, and that exactly is what has been cleared by the cabinet as well. Having said that, you have asked specific questions on likely timelines. So basically, matter of procedure now, as in how the preferential allotment and the open offer is going to near. I mean, that itself will take around 2 to 3 months to kind of unfold. That's the time when you can say that the deal is actually done practically. Importantly, we are also given to understand that, an in-principle kind of a clearance by MCA through the CCI in terms of the competition angle. I mean, that basically that in-principle nod has actually already come in. Though, of course, both the companies or, either of them will do the needful in terms of taking a formal nod as well. The sense that we have gathered also is that probably an in-principle nod by the banking regulator also may already be in place. But I suppose the needful by the companies will still have to be done. This is a very clear sense that's coming out. So in toto, it's in principle, it's a done deal. The procedures now remain. So once this is now communicated, so it permits IDBI to basically accept LIC's offer, and then the preferential allotment, the open offer, all those things will be worked out probably over the next 2 to 3 months. Things will be in place. Yeah. And down the line, the important point also here, and which is what we had also flagged off, that there is no cash benefit for the government in this. It's a dilution of promoter shareholding. It's not disinvestment. So there is no premium that the government has either demanded or will get. So that is very, very clear.
Okay, so it's just a matter of time for the dotted line being signed. Thank you, Sapna, for joining in with that. In fact, we're also learning from the government that the government is planning to launch the 4th tranche of the CPSE Exchange Traded Fund in September this year. Now, the government, which has already raised over 11,500 crore rupees, while the last 3 tranches is looking at a mop-up of around 10,000 crore rupees this time around. Now, the CPSE ETF, which functions like a mutual fund scheme, comprises scrips of 10 public sector enterprises. But this time around, the government may rebalance the index to include some defense stocks. So that's the other big story from the national capital. But back home, the government's draft e-commerce policy that seeks to create a level playing field for Indian online retailers may be giving big boys Amazon and Walmart sleepless nights. And why is that? Well, one of the key recommendations was that group companies of e-commerce players from directly or indirectly influencing selling price of a product. But perhaps the biggest setback for foreign players is the recommendation that a sunset clause defining maximum duration of deep discounts be put into place. Priya Shetty is here with the details. Priya, why exactly does the government want to regulate prices, and take us through all the highlights of the draft e-commerce policy?
Well, absolutely. The draft e-commerce policy seeks to create a level playing field for domestic as well as foreign e-commerce players. Now, the recommendations highlight several areas like regulation, funding, pricing and discounting, as well as data storage, consumer grievance and protection. Now, it also talks about setting up a single regulator to govern the e-commerce sector, who will also focus on FDI implementation issues. Now, we've been speaking to several players from the industry, and the big bone of contention is around online discounting. Now, the three key strategies recommended by the draft policy include a sunset clause, which defines the maximum duration of differential pricing strategies or deep discounts that are implemented by e-commerce players. Another strategy recommends restrictions on e-commerce marketplaces or group entities to directly or indirectly have an influence on pricing. And the draft policy also places curbs on related party sellers, which means that the bulk purchase of branded goods like electronics by related party sellers, which lead to price distortions, will be prohibited. Now, if these recommendations go through, it could result in the end of the mega online sales. Interesting to note why the government is looking at regulating these prices. Foreign funding is perhaps making it difficult for domestic players to compete with the big boys of e-commerce. Domestic retailers also allege that e-commerce players have been violating FDI regulations. It remains to be seen how the draft policy finally shapes up for the industry.
Oh, absolutely. And of course, it'll take some more time for us to actually see that becoming a norm and being trickled onto the e-commerce players. For now, let's get to the other big story that was flashing on your screens a short while ago. Yet another legal setback for the Singh brothers in the Fortis versus Daiichi case. Ashmit Kumar is here with the details. Ashmit, Delhi High Court has made some strong observations. Take us through what transpired in court today.
Well, the big takeaway from today's proceedings has been that as far as this battle between Daiichi and Singh brothers are concerned, it is now beginning to take a toll. The Delhi High Court making it very clear that there is repeatedly, despite repeated orders, not enough clarity coming from the Singh brothers with respect to their assets. And on back of that, the Apex Court expressing its frustration, making some observations, but essentially the takeaway being that Singh brothers have been asked to appear before the Delhi High Court. This is a summons that has been issued by the Delhi High Court to appear before them and to clarify before them once and for all as to the status of their assets. Now, keep in mind, all of this is in pursuance of Daiichi seeking to enforce an arbitral award of 3,500 crore rupees against Singh brothers. And in pursuance of that, Daiichi had essentially been seeking a stay on the transaction, on the deal that was arrived at between Fortis and IHH. Now, what was essentially transpired is that repeatedly Daiichi argued that this is a company that is controlled indirectly by Singh brothers, Fortis Healthcare, that there are a number of assets overseas which they're not revealing before the Delhi High Court. And in fact, that has been a stance that has been taken by the Singh brothers, that Delhi High Court does not enjoy jurisdiction beyond India's borders, and hence Singh brothers cannot be asked, cannot be directed to reveal their assets overseas. Nonetheless, the Delhi High Court observing that enough is enough, that they've seen enough, that they do need clarity, and that they see no alternative but to summon Singh brothers. So the date that the Singh brothers are now looking at is August 10th. That's when they'll have to appear before the Delhi High Court, and then we'll have to clarify as to the status of their assets, again, before the Delhi High Court. Back to you.
Okay, so we'll wait for that follow-up hearing, Ashmit. But the other story that you have been tracking, telecom regulator TRAI has recommended slashing of spectrum pricing in some specific areas. What's happening on that front? And, that's a pretty long document. So what are the other takeaways of the latest recommendations as far as spectrum pricing is concerned?
Well, the great takeaway has been, of course, the slashing of prices as far as 700 megahertz spectrum is concerned. Keep in mind that in October of 2016 is when we had the last round of auctions, and in that round of auctions, the much sought-after 700 megahertz spectrum was up for grabs. Now, what's interesting is that despite that being the most sought-after spectrum, there was absolutely no bids that had been submitted as far as 700 megahertz was concerned. It remained unsold only, as per the telco's version, of the high pricing that had been, in fact, that had been provided for by the DOT. Now, on the back of that, there were consistent demands made for rationalization of pricing of spectrum. And it is on the back of that that the TRAI, after nearly a year now of consultations, consulting not just local stakeholders, but also stakeholders overseas, what we understand is that the TRAI has come out, at least as far as 700 megahertz spectrum is concerned, the TRAI has clarified that the pricing needs to be halved. It needs to be brought down. There needs to be a certain degree of rationalization, and on the back of that, the pricing that has been now recommended has, of course, been halved from what it was back in October of 2016. Having said that, let's also clarify that these recommendations are not binding on the DoT. It is for the DoT to consider and then to arrive at a final decision. But nonetheless, given that the telecom watchdog has expressed its view, it does carry with it a certain amount of weight. So all eyes now on the Department of Telecom on a decision that they take going forward as far as the timing and the pricing of spectrum options are concerned. Back to you.
Okay, Ashma, thanks for taking us through those stories. We'll let you get back into court for now. An important clarification coming in from TRAI. Those are recommendations right now. For those to be cleared, it has to be passed by the Department of Telecom. For now, quick break. On the other side, July sales data paint a mixed picture for the auto sector. Details when we return. Welcome back. Now it's a mixed bag for the auto sector as far as July auto sales go. In the two-wheeler space, Bajaj Auto, for instance, reported strong sales, while Maruti Suzuki saw sales drop for the first time in 19 months. Commercial vehicle major Ashok Leyland, though, has been stepping on the gas. It reported a strong 27% growth this month. Sonia Shenoy is here with the details. Sonia, though most automakers have done well in July, it still seems like a mixed bag. Take us through the numbers.
Yes, it has been actually. So just to take you through the numbers, largely the numbers have been good. The only disappointment this time was from Maruti. That's because the numbers, were below what the street was estimating. The growth rates have been impacted because of the high base of last year. Same time last year, there was a lot of inventory stocking because of the post-GST, transition that took place. So on account of that, growth rates have fallen. But even though, we were factoring that in, it's still lower than the street expectations. That's because a couple of its key segments have been under pressure. Barring the compact car segment, all the other segments have actually fallen this time around. The mini car segment has been under pressure as well. Apart from Maruti, all the other companies have done well this time. Ashok Leyland has reported a strong 25% plus growth, 15,000 units of sales for the second straight month in a row. It hasn't yet seen any impact as far as the trucker strike or the new axle load norms are concerned. Maybe that will come in the following month. But for now, Ashok Leyland's numbers look quite good, better than street expectations. The other numbers are also good. Bajaj Auto reported a surprise this time. 4 lakh units, slightly better than what the street was estimating. The management said that August will be better than July, especially in the domestic market, and they're expecting 4.5 lakhs per month in the months of September and October when the festive season starts. All in all, good set of numbers. M&M's numbers were also good. Both the tractor and the auto space has grown at a strong clip. So barring a disappointment from Maruti, all the others have done well this time around.
All right, Sonia, thanks for joining in with that. But with that, completely out of time on this edition of After the Bell. Stay tuned to CNBC TV18. GST Centimeter is up next.